Anna, can you tell us about your business in 30 seconds?
I help business owners and real estate investors pay the least amount of taxes as legally possible, just like wealthy people do.
That was something I was always inspired by when I was getting into real estate, reading Rich Dad Poor Dad. It talks about having a tax advisor. And when I was getting into it, I asked my CPA how I could save on taxes. He's like, "Oh, you made money, so you can't." And I was like, I feel like you're not telling me something. But that's kind of when I realized a CPA, and he's great, he's really good at filling out the paperwork, but he's not great at strategizing on how I could fill it out more efficiently or do things in my business differently in my case. And so you're the person who's what everybody really wants is like the strategy part, right?
Yeah, so there's a difference between a tax preparer and a tax strategist. And honestly, I just think there's a lack of education to American citizens on what the difference is, because we're so used to just going with a tax preparer who is absolutely needed, David. You need someone to actually be in compliance with the IRS. At this moment today, there might not be an IRS. I'm not really sure.
Yeah.
But right now, there still is. So pay your taxes. But so you need that. But the problem becomes when people get sick of every single April saying, hey, I owe $10,000. Now what? And you're like, oh, crap. You needed to plan all year round. So that's where the tax strategist really comes into play, especially when you have business or real estate and you decide, okay, if I'm going to sell this property, what is it going to do for my tax situation? You have to be proactive, but there's a lack of education on that's what's needed, what's not needed. So if you have a business or real estate, you should do tax planning.
Mm-hmm. We all hear about in real estate, you have like 4 ways of making money. And you hear it, and then like one of the ways is like tax savings, right? Could you walk us through some of the standard tax savings that you can get from owning real estate or having a business in real estate?
Yeah, it's so funny because people who have a W-2 always are the ones who complain, and there's nothing wrong with that, okay? So when you have a W-2, there isn't really a lot that you can do. I say play the game, right? It's when you start having a business or real estate where you can really start playing the game like other people do. And let me get to your question in a second, but the Internal Revenue Code is not how to pay taxes, it's how to avoid paying taxes. So you just gotta have someone
right,
to like-
because by default, everyone pays taxes.
Exactly,
yeah.
And it's people who are wealthy who make these laws, by the way. It's not just like people down the road just making these laws. It's wealthy people realizing, what do I need to do not to pay taxes? And we'll get into a really cool loophole and you'll understand, and hopefully your listeners will understand why the wealthy make these laws. But to answer your question, number one, if you own real estate, what you want to do is do a cost segregation. It's accelerated depreciation on your rentals, which is wild that people still don't know about this. We had a client who had about 6 commercial properties in California, has worked with a CPA, and it's always like, they're so nice, we love them, but they never provided strategy. So they were paying about $200,000 in taxes, and I asked them if they did cost segregation, never have, on a $10 million portfolio. So those are little strategies that, not little, but that's a really big strategy for real estate investors. But when you're an investor, you also have a business. So you can actually now deduct a lot of things. You know, you see online all the time, people are flying first class. So sure, if you can afford to fly first class, you can actually deduct it. You don't have to sit all the way in the back, right? So
Really?
You don't have to.
Okay, but you could deduct both either way, right?
You can deduct both. If you like to fly in the back, you can still fly in the back. I'm not saying one or the other one is better, but it becomes a little bit more fun when you see that you can, hey, I need a new computer. Maybe before you were just buying the basic one, but now that you have a business, you're like, let me invest money because it's actually a write-off. So there isn't always like a list of things that you can write off. It's just what's ordinary and necessary for your business. But for real estate, 100% cost segregation is the biggest one. And what you want to have is active income and passive income. Active is, you know, you're being a wholesaler, you have a podcast, a consultant, and fuel that money into your passive income, which is real estate.
Got it. I should be making more money from my podcast is what I heard from you saying.
Absolutely.
That assumption. So can you break down what a cost segregation is? From what my understanding is you know, houses are made of materials, and the normal depreciation lets you say, hey, if you get a new roof, this will become a less valuable roof over time until 27 years pass. Now the roof is worth nothing, right? So they kind of let you take the depreciated amount of your roof over 27 years, like on your taxes every year. But there's a strategy called cost segregation. And if I were to explain it to somebody, I'd be like, well, if you have 2 sets of lights in your room, then I don't know, somebody comes in, they say, well, this light costs this much, this light costs this much, and it ends up to be a lot that you can depreciate quickly.
That's a perfect way to explain it, actually. I've never thought about it that way. But sometimes these laws are so complicated that I hate the word dumbing it down, but like that's what we do for our clients. And like when I talk to my attorney, I'm like, I don't need your attorney lingo. Tell me, dumb it down for me. So that's what we try to do with our clients. So I think that's a perfect example. But cost segregation is exactly that. You have a building, let's say, of $1 million. And what happens, you get, the IRS says, hey, here, you're gonna get a 39 or 27.5 depreciation, which takes a long time, right? So it's really not giving you much of an expense. So what a company comes in and they start breaking down everything in the building. So they say, okay, the flooring, that's only gonna last you 5 years. Your fixtures, only 7 years. So what will happen is those assets will be, back in the day when it was a nice day, would be 100% depreciated. So on $1 million property, you're looking at about $350,000 of the first year write-off. That would never happen. Now this year in 2025, it is at 40%, but when it was 100%, that's a $350,000 write-off against your income. That's supposed to be coming back, I'm not really sure, but that's why it's so powerful to have real estate and cost segregation.
Can you do it on single family homes as well as commercial buildings? I hear
Yeah.
it a lot with commercial buildings.
It's a great question because people always say, well, my house is only worth $250,000. And what you want to do is make sure you get an estimate from the cost segregation company, because there isn't a, if it's like $50,000 or $100,000 home, it's probably not worth it because the ROI is just not going to be there. But always get an estimate from the cost segregation company and say, hey, how much is this going to give me? Because I've seen it on $250,000 homes. And if you have multiple, you add them all up and it's worth it. So there isn't really like a value of a home. And if it's below that, you shouldn't do it. Just get the free estimate and see how it plays out.
Okay, got it.
Yeah.
Are there any other tax strategies with real estate?
Yes. So, well, besides writing literally, people say like, oh, you can write your entire life off, right? Real estate, I will agree, is not going to make you rich right away. It is a long game, right? So that is the biggest way to reduce your income in real estate. Other things that you can do is by having a business. That's why I love having a business with real estate, because you're able to play the game in the business a little bit more. Because the goal of real estate is to have it at zero, right? Or negative. But with a business, you want to have, obviously, you want to be bankable so you can buy these built buildings. But there's a lot of strategies as a business owner. If you have a lot of active income or income in the real estate, well, then you can do that. But I was telling you the example of how the rich make these laws for the rich. Okay, well, there's this crazy one. It's called the Augusta Rule. I don't know if you've ever heard of it.
Yeah.
I'm sure you have. It's very common. But it came from the wealthy people living in Augusta, Georgia, who said, hey, I'm renting all these homes for like $20,000, $30,000 a night. I don't want to pay any taxes on it.
Yeah.
So in my head, I assume they all got together, like drinking whiskey or whatever, and they're like, hey, let's lobby. We're not going to pay taxes on this. We'll rent it out to you guys, but we're not going to pay taxes on it. So as a business owner, the rule is you can rent your house or your second home, for less than 14 days a year and not claim any of that on your taxes.
So I used to own my home.
Okay.
And now I rent this place. So I kind of shot myself in the foot there, because I can't do the Augusta Rule, as far as I know, when I'm renting. But when I owned my home, we would do that, and my business would rent space, from my house for those 14 days.
Yes.
Yeah.
So that's a great strategy. I haven't been through your house, but like an example, if you did have a room specifically for the business, you can rent it to your business.
Yes.
Even though you rent, it's perfectly fine.
But that is a different rule, though, I think, right?
Yeah. Yes, you're right. Now we're getting a little more into it. But yes, if you own your home. So for example, if you own this and what is that, the race car that comes here every year?
Well, I have my own race car, but there's Formula
That is true.
One's
Yes, Formula One. Yeah.
Yeah.
So, or if you ever wanted to rent this for any Airbnb, like you can rent it less than 14 days and not claim, even as an individual. We're not even talking as business, but as an individual, you can also do it.
Okay, cool.
Yeah. So that's a great strategy. We'll talk about paying the kids and then the self-directing IRA. But I want to make note that all these strategies are really cool, but you have to be making money, right? Like everyone is always like, oh, I want to do these strategies, but you're not cash flowing. So you need money to make strategies. So the second one is self-directing your IRA. When you start making money, that's when things become fun. If you don't have tax problems because you're not making enough money, right? Because that's when the game really starts playing. So self-directing your IRA. So let's say you have all of this money. Sitting here and you're like, hey, I don't really need more income. How can I make money without being taxed? And where wealth is really made is in the self-directed IRA box. So you want to take some of your retirement money and put it into your Roth IRA and then self-direct it, which I don't know, a lot of people just think that they have to leave their money with Schwab or Fidelity, but you can actually invest in your Roth IRA and never pay any of taxes in your Roth IRA. So that's a really great strategy.
So yes, I looked into self-directed IRAs. I personally haven't taken advantage of it, but let me have you break the shackles, so to speak. I think I have like $150,000 in my Roth IRA.
Okay.
And then I'm no longer able to contribute to it because I make over $250,000 a year. I don't know what the limit is. What's the limit for a single person?
I don't remember what the limit
something like
for
that.
married is like 214.
Yeah.
But you could get there really fast.
Okay.
Yeah.
So anyway, I never bought a house with that because I didn't have a $150,000 house. And I also heard that if I spend the money, I can't then also manage it myself, which I do, right? I have like a employee that manages it. So I was like under the impression that if I invest in real estate with it, I couldn't actively participate in it as a business. Is that accurate?
Yeah, no, that's accurate. So with self-directing your IRA, there's a lot of rules that come with it, but let me throw it to you this way. What if you can lend it, do some private lending out of it, right? What if you have someone that comes to you, David, and it's like, hey, let's do a flip together, and we're gonna make $50,000 each. Sure, you can add $50K to your taxable income, but I always say to people like, do we really need it right now? If you do, great. If not, have your IRA be the partner so that $50K goes into the IRA and you're not never taxed on it. So
wait, I could partner with my IRA?
You can't, but if I come to you,
Gotcha.
yes, if I come to you and I say you want to do a flip, we'll do it with your IRA. But that means that neither you or I can go in, like, not that I'm going to, but like change floors or paint or anything like that. Like, you do have to be very hands off, but it's a great way to create wealth. So I would definitely advise that you should do something with that 150. At least lend it out. It's just sitting there doing nothing.
Yeah.
So you should definitely do something with that. But yeah, you cannot buy a flip and be active in it or anything like that.
Okay.
Yeah.
Here, I've got another one.
Okay.
So you know that rule 179 that all the Instagram influencers use to write off their G-Wagons?
Yes.
Okay. Well, I saw a video and it said you can actually write off part of your house if you have a rental property. And I was like, this doesn't seem right. And so the person said, under certain circumstances, if you're operating as a business, you could write things off like foundation repair or like a garage door repair. There were a roof repair listed. And I was like, this can't be right. And I asked ChatGPT, it said no. Then I asked my CPA and he's like, well, here it is. You did it last year. I didn't even know it. And it was like a microwave and a garage door.
Oh my gosh. Okay, there's a lot of things that we need to discuss here. First, let's go with the fact that the answer is like every answer you get from your CPA is like, it depends. Now, first I want to mention a lot of people, and I'm gonna call you out, but I'm not, because a lot of people are like, oh, I didn't know I was doing this on my taxes. They're like, oh, I just pay my CPA to do whatever they do. And it's a misconception that if something were to go wrong, know that you, or I'll say me as an individual, I'm responsible. Like, when you sign that CYA letter before tax season, that's a CYA letter for us, okay, saying, hey, whatever you tell us, I'm gonna do. So in case of an audit, David, if you're like, well, I paid Johnny $50,000, he should have known, the IRS is like, I don't really care, I'm not going after Johnny, I'm coming after you. So make sure that if you do taxes that you get not saying that you don't, but a lot of people just sign the dotted line and they put all of the risk on the CPA, and that's not going to work out. So at least get an understanding of what's on your tax return. And I'm not saying you don't, but that's just like a little fact. About the house, sure, it can be done. So let's say you live in your house and this happens a lot, house hacking. Like, I personally hate it. I don't think it's worth it, but because they'll live in the house and
yeah, okay.
Is that what I'm talking about?
No, I want to hear exactly what you're saying. I did it. I would hate it now. But back when I was like 20.
Okay, we had no money, and I was like, yeah, as a guy, I think it's different. I would never, but I hate it for the fact from a tax preparation standpoint. I don't hate it from a finance standpoint. So, because it doesn't give you that much benefit. Is it going to cash flow probably better than you renting a duplex? I'm sure it does. But from a lot of people were like, oh, I'm house hacking one room in my house. Can I deduct all this? And I'm like, Sure, but a lot of the times it's not worth it in the long. I mean, you still have to claim all the income, don't get me wrong, but I'm like, your house hack, they'll say, I'm house hacking one room, and then I moved out, and I'm moving upstairs now, and I'm like, oh my gosh, it's so much work for literally a $2,000 tax savings. It's not worth it, and then they want to sell their house, and it's not a primary home anymore. So given all of that, because it does become complicated, make sure you consult with your CPA just to see what the tax benefits are. Now, if you want to have a rental in your home, you can deduct a portion of, if you have to fix like the garage door, yes, you can. Is it worth it? I don't know.
Okay. Well, here's another thing that we haven't mentioned yet for taxes.
Okay.
One of the things I love about real estate is you borrow the money to buy the rental property.
Oh, yeah.
And when you take out the loan, it's $150,000 and you have to pay it back in 30 years, where inflation has devalued the dollar 3% every single year. So you borrow it, it's worth way more. Like you could buy 1 million turkeys with $150,000 today. And by the time you have to pay it back 30 years from now, that amount of money would only buy 500,000 turkeys. So it's just a really, really great thing about lending on real estate. But people are then like, well, what about the interest that you pay? But that's actually something you can deduct on your taxes.
Yes.
The interest.
Correct. So interest is something that is a deduction on your taxes. And I do believe that people get so stuck on, oh my gosh, it's 7%. Oh my gosh, I need it at 3%. And it's like, we don't really know. People live in the future. I'm like, you live today. If the numbers make sense with 7% or 3%, just do it, buy it, and move on with your life, because you're creating generational wealth for you and your family. So yes, interest is a huge deduction, but also the appreciation. I mean, in Austin, it's crazy, the appreciation, right? People don't buy a lot for cash flow here. So it's like, depending on what market you're buying, don't worry about the interest rate. And then the cash out refi. That's literally free money that you make. So if you buy a house for $100,000 and in 5 years it's $1 million and you want to get 80% of that, all that cash that you're getting back into your pocket to reinvest in a business, real estate, cars, whatever you want, it's tax free. So I think the problem that a lot of people have is they just get upset about what rich people are doing. And I'm like, if you can't beat them, join them.
Yeah.
Copy and paste whatever they're doing. That's exactly what you need to be doing. Obviously, it sounds easier said than done, but with house hacking, it is a great strategy to generate cash. From a tax strategy, I hate it, but that's what they pay me for, to do it, right?
I love it. Okay, so here's another one.
Okay.
So I actually bought a house for like $1.1 million. And I had somebody pay me rent to live there for 2 years.
Okay.
And I also rented it out for the max that my business could with the Augusta Rule.
Perfect.
Which is pretty big, actually, because you can figure that out. So those are two things right there. So I had help with the mortgage payment. And then I sold it for 25% more 2 years later than I purchased it for. And one of the great things about a primary house is I think $250,000 of gain is tax-free.
Yes.
Right?
Amazing. And
so basically paid no taxes on the entire gain.
The entire thing.
Right. And I only paid half the mortgage payment because someone else was in there paying rent with me. And my business had the tax savings as well.
I mean, you can stack and stack and stack all of these strategies, and literally at the end you realize that you pay 0 to no taxes. The Section 121 is what you're talking about. And even if you live in a home for 2 years, 2 out of the last 5 years. So let's say you live there for 2 years and you're like, I don't want this anymore, let me rent it. You can still qualify for the Section 121. It will be appropriated, is that the word? English is my second language.
If I rent it?
Yeah, so like if you live in it for 2 years, let's say, and then you're like, let me rent it for 2 more years.
Oh, but I did not though, because I was living there also.
Correct, yes, so you did it the easy way. But other people, you can live in it for 2 years, rent it for 2 years, and then sell it. And you would still qualify a portion of it for that Section 121.
Okay.
But so you can still do both, or just live in it for 2 years and sell it. But you're still qualifying 2 out of the last 5 years. So it's really nice. So you still qualify for that as the Section 121, which is if you're single, $250,000, and it's $500,000 if you're married.
That is so much.
I know, that's so much money.
Yeah.
I know. So it's like, don't go get married just for that reason, but you should marry someone who is real estate professional status.
It could cost you a lot more.
Yes, actually.
Getting married
yes,
as well.
I agree. And having kids. A lot of people are like, let's pay the kids and have kids. I'm like, kids are way more expensive than your tax write-off. So, yeah.
All right, so another tax trivia
Okay.
that a lot of people probably know, but it's worth mentioning since we're just rattling off lists.
Yeah,
This seems
absolutely.
fun. Is when you have a primary residence, typically you'll pay a reduced property tax rate than if it is a rental property. I noticed that it's called like a homestead, et cetera. So I assume people know that, but just wanted to say for those that don't, if you live in the house, you could pay half the property taxes in some place. It depends on the city.
It depends on the state. Not every state has a homestead.
Oh, really?
No, Texas is one of them. But
Oh, they don't have a homestead in Texas?
No, they do in Texas.
Oh, they do.
But not in Wisconsin.
Oh,
I'm from
okay.
Wisconsin. They don't have that there.
Oh, wow.
Yeah, so that was a new thing I learned when I had clients.
Oh, okay. I think it's pretty common. A lot of states do have
Yeah, very common. But not in, so in Wisconsin, it doesn't matter what, it could be rental, it goes by the value of the home. But here you get a credit if it's your primary residence on your taxes called like the homestead credit.
it. Right.
And then when it goes to investment, it changes. So it does depend by state.
Yes, I forgot to tell the city that I moved out of one of my houses
Okay.
and it became a full rental property.
Uh-huh.
And so 2 years later, they actually contacted me and said, hey, we're going to need those taxes. Because it's like in Carmel, Indiana, which is where I'm from and where my properties are, it was like 1% was your property tax every year. So if it's like a $100,000 house, you're paying like $1,000 in taxes, I think. So it goes up to 2% if it's a rental property. So I bought the house hacked it, then I moved on and I rented a place after that. So they didn't know that I had moved.
Yep.
And then like eventually I ended up buying a house that was my new primary residence. And they're like, wait a minute, thought this one was your primary residence. So yeah. That can, and it wasn't a big deal, right? It was like owed and no problem, but just something to be aware of if you own a house. Definitely need to apply for that homestead tax exemption.
It's a very, like I guess we don't have that in Wisconsin. And this is like other things too that you're not supposed to know this, right? Like how are you going to know this? But this is why having someone on your side to give you this, because there's also a lot of states that, let's say you buy a house and then you're like, hey, I want to transfer it to my LLC so that it's investment. There's a transfer tax on a lot of states. It might be 2%. So you're like, do I really want to, is it worth transferring into an LLC? You want to be proactive with everything you do when you get to a point where you're like, okay, I'm making a lot of money. I can't just throw this money away. So that you're not making decisions and then you're like, oh shoot, now I owe all of this.
Yeah.
So yeah, very interesting. I did not know that about Indiana. That's really low. Is it 1% for real?
It is pretty low, yeah.
Oh, wow, that is really low.
But they have state income tax. And in Texas, we do not have state income tax. So the property taxes are a little bit higher, I think, to make up for that.
Yeah.
I think, what is it, 2 to 3% here in Texas?
Really expensive.
Yeah, it is kind of expensive.
Actually. But I guess it all, exactly, when you live in a state like Indiana and Wisconsin where they have property taxes and state taxes, I'm sure it's all the same at the end of the day.
Yeah.
I agree.
I was looking at a property out in San Marcos. We have a racetrack that I'm a member of.
Okay.
And you can bring your car and you could come any day and drive.
Cool.
It's fantastic. But a lot of that area between San Antonio and Austin has been developing. And so people have owned just barren plots of land out there. And one thing that I saw in particular was this guy used to owe like $3,000 in taxes every year for his land. And all of a sudden now he owes like $27,000.
Yeah, because it's as soon, like,
Yeah.
he should sell it.
Well, yes, we were talking about that. I said the same thing.
Yep.
And I think he wanted more than what comps would say.
Yeah.
What's really interesting is, so there's lots of subdivisions out there, and obviously that was like a massive plot of land. And if you break down the land portion of all those houses, it's like so much per acre, right? Like 70,000 per acre. But if you look at like 10-acre plots of land, there's no 10-acre plot that has sold for 70,000 an acre. And so that's where he's like, well, I'll sell, but only for this price. And it's like, well, that's a little bit unfair of them, I feel like, to assess your property at that value because there's no comps for big pieces like that. So we haven't sold, we haven't like done a deal or anything yet, but Do people fight that, or do you get into any of that type of tax?
So no, but what he's doing is, so land flipping is extremely lucrative. Okay. So you should send him to me, be like, just sell your land. Like, he's trying to get what a subdivided plot would look like, and it's not going to happen unless you bring in the utilities and whatever, all of that stuff. I don't know what it's called, but like, you got to bring in the water and whatever, all that stuff. If he were to do that, then he could get it, because then a builder would just come in and they don't have to do all of the whatever it's called. I'm sorry, I can't think of the name. But if he's just selling a plot of land, then you have to come in, you have to subdivide it, you have to bring in the utilities and all that. So he's trying to sell it as it's already put in everything, which is not going to happen.
Well, I agree, but the county assessed it at that level.
Wow.
So
I would fight it.
Right, that's what I'm saying. There's got to be a way he could fight that. He needs legal help or somebody to help fight him. Help.
So wait, what? He's not going to fight it. You have to fight it if you want to buy it, because he's like, well, if the county's telling me it's worth 10 million, it's worth 10 million. So that's where the buyer would have to come in and fight that, because well, it's not worth 10 million. No one's ever going to.
But if I get it down to 3 million, then maybe he'll just keep it.
Yeah, or do seller finance.
That'd be cool too.
Yeah. I mean, land flipping or land developing.
How would I fight it? Do you know? I know it's not maybe your specialty on the county side, but
I think I would just find brokers who have done deals, like actual land developing deals, and come like with real comps. But at the end of the day, here's the thing: make it a sweet deal for him. I would definitely do, hey, from a tax perspective, if you sell it right now to me for 10 million, you're gonna have to pay capital gains. Johnny, do you have that? And he's like, no, I don't have that. So you're like, don't worry, let's do seller finance. How about you become the bank and you don't have to pay all of the capital gains at once. We split it in 5 years. So you always got to sweeten the deal for them. So I would get the broker and then see what makes sense to them. Because what is he doing with this land? And if you subdivided, you're going to make 10x on that.
They have a lot of goats.
Oh, goats. Okay.
Just for fun.
Just for fun. Okay. Yeah. Well, those will go away when all these people start coming over there. But yeah, that's interesting. But yeah, we have a lot of clients who do land developing. Some in North Carolina, Indiana, Ohio. It's wild. You buy this land for nothing and then you sell it to these developers for 10x. So speaking of your Roth IRA, that's where you can lend money to.
Got it.
Okay.
I have another question. Flipping houses. It seems to be a rule that if you flip a house within less than a year, you pay a higher tax rate than if you were to hold it for a whole year, right? Because it's active income if you flip it really quick, and it's capital gains, I believe, if it's owned for over a year, right? Long-term capital gains, which is what rate? 20, 25?
20% usually for high net income earners.
Which is lower than any federal tax rate.
Ordinary,
anyone's federal tax rate.
Exactly, but it really depends actually. So I'm not in the world of flipping. Okay. But if I were to flip one tomorrow, mine would probably be taxed at capital gains, which I want it to be, right? At a long-term capital gain, which is 20% versus short-term is your ordinary tax rate. However, if you are in the business of flipping properties and that's all you do or a majority of your income, you should be taxed as an S corp most likely, which then you would avoid any capital gains, even if you sell it, if you flip it like in a month. So making sure that depending on if this is your just once in a while I want to flip, or hey, this is really my business, there's a different structure like an S corp that would save you way more in taxes. So make sure you're proactive with your CPA.
Got it.
Yeah.
So can you tell me, how did you end up in this niche focusing on the business side of real estate?
It's such a funny story, but my grandpa had no idea. I'm from Mexico, and my grandpa, first, actually, let me tell you the real story. The real story is I quit my 9 to 5 because like I hate it, like all of us, right? Like I'm not going to answer to anybody, but now I have 1,000 people I have to answer to, so I don't know which one's better. So I was like, let me just do taxes. I was literally handing out like cards like back in the day when there was no social media, like at grocery stores, like I'll do your taxes for $40, didn't know anything. And then I met this client this old couple who had 40 properties in Wisconsin, and they paid 0 taxes. And I was like, how? Because I have attorneys over here who are making $500,000 paying $250. So literally that's what I was like, let me figure out, I'm a copy and paste kind of person. What are they doing? Let me do it. And then let me teach other people how to do it. So that's literally how it started. And then going back to my grandpa in Mexico, he was always traveling with us. And I was like, oh, does he have a job or what? he was a real estate developer. So I was like, oh my gosh, I had this in my veins. I just didn't know until I realized what it was. So then I realized how the importance of having a tax strategist was. And real estate is like my passion. I love to do it. So I'm like, if I like to do it, I might as well do it and teach other people how to do the same thing.
Got it.
So now that's why I'm here.
And what led you to, are you a CPA?
Yes.
Okay. What led you on that path?
My mom was a CPA and didn't know what else to do with my life. So like since I was like in 7th grade, 8th grade, I was like, hey, I want to be a CPA. It sounds so much fun. And then I went to public accounting. And if anybody has ever been into public accounting,
That's for working at like a big firm, like Arthur Andersen back in the day.
Like Baker Tilly.
You kind of audit like a big Fortune 100 company, right?
Yes. And it was horrible because you worked so many hours. I hated it. I just hated it. I lasted 3 months. Like I was literally the shortest. I was like, this is not for me. I don't want to do it. I got my CPA, went private, and then I was like, I also hate this. Let me just start my own business. So I started my own business. It sounds easier than it was, but I would never go back.
Got it.
So yeah, now I just practice what I preach.
Why do those public accountants work so many hours? It's just a big part of the culture.
It is a culture which I respect. I respect the culture because I do think that nowadays people just want everything handed to them. I'm gonna like date myself, but I mean, I'm sure you have where these kids come in, they're like, I want $100,000. I'm like, for what? Like you haven't worked, you know? So I do respect that culture for a little bit. I do feel that every time I saw a partner, especially as a woman, they may or may not have had a family. And if they had a family, they never saw their family. And I was like, cool, I'm making $500,000, but I'm always here. My kids don't know who I am. And some people love that. That's not how we were raised. So I never wanted that for me.
Got it.
Yeah. But you get a lot out of it. I mean, if anyone's in accounting, I always encourage them to go do that and then go start their own accounting firm because do you want to hear a crazy statistic?
Yeah.
70% of CPAs will retire in the next 10 years. And it is the lowest degree that's being handed out. So like, how is that going to work out?
Got it. So there's not enough to replace
Correct.
all of that. So the value for that service will definitely be going up.
Correct. Right. And people think that AI will take over, which I do think that AI will take over doing a regular 1040. I mean, literally, and you should. It's going to be free. But tax strategies and reading the tax code, I don't think that's ever going to go away. So I don't think anyone should be worried about that. And if we are, then we'll figure something else out. I'm not living in the future.
Yeah, it's one of the things is like worrying doesn't help anything.
No.
It's almost like worshiping the problem. We should focus on what's here right now. 99% of the things I've ever worried about in my life have never come true. And you look back at all that wasted time.
It's so true. And I'm very religious. So every time I'm like worrying about something, I'm like, dang, I'm worrying about something that has nothing to do with like my goal, what I want to do. So like, I just go and pray about it. But yeah.
Well, thank you so much for coming on, Ana.
Yes, thank you, Dave.
Who should reach out to you and where can they reach out?
That's a great question. So really our services are targeted for business owners or people who are in real estate owning about 3 properties or more. That's where we can really bring on the value. You can reach out us on Instagram, fill out our questionnaire, and then we'll be able to hop on a call with you.
What about a wholesaler if they don't own properties, but they're doing that business?
Yes, so if you're a business owner, sorry.
That would be included
that would
in
be
that,
included.
for sure.
Yeah, so business owner or both, or just real estate or just the business owner. Yep.
Cool. Well, thank you so much.
Of course, thank you so much.
It was really great to have you.
Likewise, thanks again.
Yeah.
Thanks for listening to the DealMachine Real Estate Investing Podcast. Please leave us a review and follow along wherever you're listening to your podcast.